So we're going to talk about hidden divergence and regular divergence. It's really a simple concept. It takes a while for your mind to adjust to it, but I'm going to make it really simple for you. All right. So with the divergence, it's when the peaks of price action is going in the opposite direction of the peaks on the RSI. The RSI on the TDI. So the RSI is that black line, the relative strength indicator on the TDI. All right, so I want to make it clear. So this black line is the RSI. Price action is the actual price action. So the peaks on price action is different than the peaks on the RSI. They're going in opposite directions. All right, so let's talk about it. You're going to have bullish signals that come from divergence. So let's say price is coming down, creates a low, creates a lower high, and then it creates a lower low. And then you look at the TDI, and TDI has created a low and a lower high, but it created a higher low. So when you put a trend on the bottom, because the price is coming down, so we're looking at the lows. The low is going down, but the TDI shows it's going up, and it's a signal that a reversal is going to happen, and vice versa. If the TDI is in an uptrend, it's going up, it's creating higher lows, and the TDI creates a lower low. It's a signal that a reverse is going to happen. And a lot of times we'll get this. We'll get a shark fin right here. So let's say the TDI is a shark fin, and we say, oh, this is going to push up. And it does push up, but it doesn't push up as far as we think it should push up. And it starts to come back down. As it comes down, TDI may fall lower than that shark fin, or just may fall lower, period. That's a signal that we're going to reverse here and continue to go up. And whenever you see that divergence, regardless of the direction, let's say price pushes down further and the TDI stays higher, that divergence is a signal that it's going to reverse and go in the opposite direction. Right? So TDI is the price action is creating lower lows, TDI is creating higher lows. Or price action is creating higher lows, TDI is creating lower lows. And the same is true for bearish, is that we're heading down, so we should be creating lower lows. But the TDI is creating lower highs. And the TDI is creating higher highs. When it pushes lower and the TDI comes higher, it's a signal that we're going to go down it's going to short off. And it doesn't matter the direction. If the TDI pushes, or the price action pushes higher, creates a higher high, and then the TDI creates a lower high, that's also a signal that price going up is going to reverse back down. All right, so that divergence is a signal that the reversal is going to take place. And it's actually our favorite move. We like shark fins, but remember, shark fins is testing it one time. So we just see the shark fin, we take it. The divergence is multiple times. So price came down, that may have been a shark fin, goes up, but then comes down lower and creates the divergence. We call that shark fin divergence, where the TDI is moving in a different direction. So that's a multiple test that gives us a sign that a reversal is going to take place. Right? So that's divergence. And we mentioned that there's two types of divergence. There's hidden divergence and there's regular divergence. All right. And so in order to understand the difference, you have to understand structure. I'm going to keep bringing back this slide, that you have to know where you're at in the structure. Are you on the uptrend? Are you in a sideways movement? Are you in a downtrend? It's important to know where you're at all times. And so if the reversal is going to take is taking place in the direction of the trend. So let's say price is going up and we're right here in time. Price is coming down to support and we see divergence here. That divergence says that price is going to reverse. It's pushing down, price is going to reverse and continue to go up. That up movement is the way the whole trend is going. So it's with the trend. So we call that hidden divergence. Hidden divergence represents trend continuation, that the trend will continue. Hidden divergence means that it's going to be a longer run, that the profit target will probably go to create a new high. All right. If it's in a downtrend and price is counter trend and it's pushing up to resistance, and we spot hidden divergence says that we're going to sell with the trend. So the profit target is longer, right? It's probably going to create a new low. And so if hidden divergence is there, we're going to take the trade at in a downtrend, we're going to take it at resistance. In an uptrend, we're going to take it at support. And usually if you find hidden divergence, you're going to find a moving average acting as support or a moving average acting as resistance. So hidden divergence usually happens where there's a moving average. Then you're probably going to find a retest of old resistance turn support or old support turn resistance. You're usually going to find that confluence at hidden divergence. And then you're usually going to find a trend line there at hidden divergence. That a trend line is coming up right through that area. So there's going to be a lot of confluence there, and all it is a signal to tell you that the trend is going to continue at this area. And so the best thing is that a shark fin is there at this area. But the next best thing or the best thing is hidden divergence is here at this area also. Right. And then the opposite is regular divergence. If hidden divergence is with trend, regular divergence is going against the trend. It's counter trend. So it's going in the opposite direction. So this is an uptrend. And then so price is pushing up and then it meets resistance and it goes against the trend. So regular divergence is reversal signal that's going against the trend. And as you can imagine, the run or the take profit is a lot shorter. That at any moment it can turn and continue to go with the trend. Right? The same thing on the bearish run. That as price is pushing down, it'll hit support and go counter trend. So that's regular divergence going against the trend. So the run is going to be shorter. It's still going to get a reaction, but it's going to be shorter and it's more riskier. All right, so that's a signal of the counter trend move. All right, so that's that. We still take regular divergence. It's just more riskier because you're going counter trend. A lot of times you'll see me and you'll see others pass. We'll see the regular divergence, we'll see the confluence, we'll say that it's going to reverse, but we'll just pass on it because we want to stay with the trend. It's a lot easier to stay with the trend. All right, so let's talk about hidden divergence a little more. All right, the characteristics, what you're going to see when hidden divergence is present. All right, so we talked about it. The first thing is that you're going to see is hidden divergence is going to be trend continuation. So if you can identify which way the trend is going, you will see that the hidden divergence should be with the trend. All right, we haven't talked about it yet, but usually it's going to be a fib level or price reversal zone. So Fibonacci is something that we use to measure the runs or the retracement, I mean. And so if I spot, let's say, a bullish trend from the low of the last run, let's say I'm looking at it right here. If I measure this run with the Fibonacci tool from the low to the high, I can measure how much of the pullback is. So this pullback usually retraces 50 to 61.8% of this move. We call them fib levels. And so what I'll see is that this run has went and then it retraced 50% of that move at a support level, old resistance turn support, at a MA, and there's divergence here, right? So usually I'll find an important price reversal zone. And so that gives me confidence that I'll hit a take profit, and we'll explain these take profit levels. But what it's saying is that my first take profit level should be at an equal high of the last high. So if I'm here, I should at least go up to the equal high with hidden divergence. And I should, if that breaks, I should continue to go up to at least the negative 27% fib level. And then if it is very bullish, then I should make it up to the negative 61.8. All right, so you're going to find some fib levels, and we'll learn more about that. Then you're usually going to find a MA rejection. So typically it's a 50 MA, but sometimes it's a 200 MA. So if you look at this example, price, there's a trend line that it's on. It keeps hitting this trend here. And then you see this 50 MA come and start acting as support. And it's acting as support on this trend line. So price is here and it's coming down to an area of old resistance that is now support on a trend line, and the 50 MA is coming up to meet it. And when you look at the TDI, this on price action, the run is going up. On the TDI, those are running down. So this high is lower than this high. On price action, this high is higher than this high. So that's hidden divergence on the 50 MA at old resistance turn support on a trend line. That tells you that price is going to go up at least to an equal high and possibly higher. Right? So we look for those confluences to be there. And then usually this stuff is happening at a key level. So it's happening at a place where there was old resistance turned support in a bullish market, or old support turned into resistance in a bearish market. So there's a lot of confluence at one area. And whenever you see a lot of confluence, a lot of stuff happening at one area, you can get confident that price is going to go in your direction. Right? Makes life easy for us. So let's look at a couple examples of hidden divergence. All right, we just looked at this example. Price or TDI is creating these lower highs, or excuse me, it's creating these lower lows. This peak is lower than this peak. And we see that if I went down a lower, that we're on the 4-hour chart. If I went down to a lower time frame, I could probably see like the hour That fit this is rejecting off probably our 50 MA. So the MA can be closer to price action. But anyhow, on this current uptrend that we're in, we're riding the trend line and price is higher than this peak. On TDI, it's lower. That's happening on the trend line and it's happening at the 50 MA. That's hidden divergence right there. And so what happens? Price rejects and goes up. All right. And you notice that it's not a shark fin. There's no shark fin present on the TDI. So hidden divergence can be used without the shark fin. It's best when there is a shark fin, but it can be used without a shark fin. Here's another example that we are on a trend line. We have multiple touches of the trend line. Here it reacted, went up. Here it reacted, went up. And now it's coming back down to the trend line. And we see the 200 MA on this 1 day. 1 day, 200 MA is coming up on that trend line. And we see the old resistance is turned into support. So those are multiple confluences. But one thing that we spot is that price became a shark fin right here. That this first move was a shark fin. If you look below, that's a shark fin. It's below the 25 and it's below the band. Now, it's an ugly shark fin. That's what we call the false shark fin, where that band begins to open up. But it's a shark fin because it barely is broken that band. And so we did get a reaction on the trend line and off the 200 where we pushed up. All right. But when we look at it, we would think that that shark fin should have, with all that confluence, pushed up to the 50 MA, from one MA to the next MA. But it didn't. It pushed up a little bit and then came down lower. And that's our best entry, because what happens is the TDI created a lower high. Price action is a lower, or excuse me, TDI created a lower low. Price action is a higher low, or excuse me, a lower low. I'm gonna get this right. Let me do this one more time. TDI created a higher low. So this high is higher than this high. Price action created a lower low. This low is lower than this low. That's divergence. And not only is it divergent, it's shark fin divergent. So there was a shark fin, and then we became divergent to that shark fin. That's our best entry, because with confidence, we can know that price will push up and go to that 50 MA. And not to get too technical, usually you'll see this because it's a liquidity grab. We know that the banks and institutions know that they're going higher, but they're going to grab the liquidity of individuals by just dipping down below stop losses. Because if I'm pushing up here, I'm setting my stop loss just below this area. And so this is a grab that stop loss and then head back up. All right, so that's an example. Let's look at another one. All right, so here we have an interesting shark fin. So we have this trend line where that has been acting as support multiple times, multiple touches of this trend line. Then we also have this resistance level. Now, price is moving sideways, but the current action is downtrend. So it's creating lower highs. It's also creating lower lows, right? So we broke through this trend line and we broke through this minor level of support. And now we're coming back to retest it. So a support turned resistance. All right, so that's one. Then we have the 50 MA that's coming down and now acting as resistance. The 50 MA, that's two. Then we have a higher high produced on the TDI, but the last peaks are lower. So now we have divergence where we're higher than the last peaks, but lower than the last peaks here. And so price will fall. And that's exactly what it does. That's hidden divergence, and price falls and creates a new low. Now here's the Fibonacci tool that we use. We stretch that from low in the trend. We stretch it from low to high to measure the retracement. This retracement came back to 38.2 on this level. That's just a price reversal zone. Sometimes it'll stretch to the 50% or the 61.8%, but that's where it reversed at the 38.2 and went down to an equal low, which we call 0%. All right. So that's a lot of confluence to give you confidence to take the trade here. All right, let's look at another one. All right, so this one here, price is falling. We're in a bearish market. We find that the lows are on this trend. So it hits the trend, goes up, hits the trend, goes up. Now it's come back to the trend. Now it's hitting the trend again right here. All right, so it gave a little reaction right here. But that reaction was a shark fin. So RSI breaks below the bands. It comes below the 25. And so it should react. And it does react. It goes up a little bit, but we're expecting it to go up to these highs. That's what shark fins usually produce, is a high. It doesn't. It goes up a little bit and then it comes down lower on price action. But here it stays higher on TDI. That's a signal of reversal. We can take the trade here, and that's exactly what it does. Is that divergence comes up to the high. I mean, so you can see the trend that it was on. It cut that bearish channel, and we take it up to the high. It's counter trend, so it's not going to produce a new high, but we can at least take it up to where the channel is. All right, any questions on hidden divergence? Everybody understand, grasp the concept of it?
Yeah, I grasp the concept. I know it's just something that I'm going to have to continue to review until it becomes second nature to identify.
Yeah. Yeah, and usually when you're doing your charting, you're just scrolling through looking for divergence and shark fins. As soon as you spot it, then you stop and look for the rest of the confluence. But you're really not wasting time on stuff that doesn't have that confluence there. That's a way that you can speed through your analysis by just not looking at stuff or spending any time with stuff on things where the TDI is just not ready. And it will take a little bit of time to keep going through it to adjust your eye to seeing this over and over again. And it happens multiple times in a day, every day, multiple times in a day. So there's plenty of opportunity to find it once you get good at detecting it. All right, let's talk about let's look at the characteristics of this regular divergence, because this is an example of regular divergence. Even though I have it under hidden divergence, the trend is going low. So this is more so regular divergence. It's going counter trend. So let's look at some of the characteristics of that. And remember, counter trend. So this is a downtrend. So this move is counter trend. This move is counter trend. Now this is an uptrend. So this move is counter trend. This move is counter trend. You're going to find that regular divergence there, right? But you're not going to find a lot of confluence around regular divergence. So one, it's counter trend. You know that you're going to is coming down to a retest. It's better just to be patient and wait for it to come to the retest and take it at the retest, but you can catch it here. We look at it as a moving train that uh, you know we you jumping in front of a moving train. So price is very bullish here. It's moving. Who's to say that it won't just keep moving and go up higher and then exhaust and come down? So you're jumping in front of a moving train here, or you're catching a falling knife. Who's to say that the knife won't just keep falling? All right. And then once you're on, who's to say that it will go up this far? We're measuring the retracement. It retraces 38.2%, 50%, 61.8. Who knows how far it will retrace? Right. So there's a lot of unknowns there, and it can be tricky to time your entries and exits with regular divergence. And then a lot of times the moving averages won't be there. So we like to trade from MA to MA, but a lot of times when it's outer space, what we call it, you won't find the MA. But if there is a MA present, then you can certainly take that, because if it's counter trend, any little MA will reject price and stop the momentum of price. It'll try to fight through it, and it can't, and fall in the direction of the trend. And then if there is no MAs present, we call that outer space. There isn't anything looking left. It's at its all-time high. We use Bollinger Bands at that point, because there's nothing else out there to say this is where it's going to reverse. So sort of what the NASDAQ is doing, sort of what the Dow Jones is doing, that it's in outer space right now. It's creating all-time highs. And so there's nothing out there to say that this is the place that it's going to reverse. So we use Bollinger Bands for that. But in every trade, you want to have multiple confluences. And this is going to be a part of your trading plan, that I will not take trades without multiple confluences there. Right? So with regular divergence, those confluences are going to be very low quality because you're going counter trend. So as long as you're aware of that, that's fine. All right, so let's look at some examples of regular divergence. All right, so here we're in a bullish move. We're creating higher lows and we're creating higher highs, right? So now we've come up to this higher high. Now looking left, we do have structure. If we were higher, we wouldn't have structure, right? But we do have it here. We can kind of mark out a resistance level. But the key indicator is that we have the divergence. Price has pushed up higher. So this was a shark fin here, pushed up above the 75, pushed up above the bands. So we did get a small retracement, a counter trend retracement that produced a lower high and looked at, or a lower low that retested the last resistance. Resistance turned support. So that was all that shark fin gave, right? Whereas this shark fin produced a longer run, and then it pushed down, became divergent. So that shark fin divergent produced these highs, right? And so you're going to see these counter trend regular divergence. So here's a shark fin. It goes against counter trend. It's just going to be a shorter move. But here, the shorter move happens, and then it pushes up higher, and the TDI stays lower. We call that regular divergence because it's counter trend. And so now we can take that back down. Oops. Yeah, we can take that back down to the trend line. Oh, okay. That was two different examples. I think it's the same example. I think it's the same one. Okay, I know what it is. I'm following. It's the same one, it's just a different time. So then that goes down. All right. So then that one went down. You had the regular divergence there, where you had the shark fin, then you had this lower high, and then that was a shark fin. So we caught that back down, and look where it came down to, the 50 MA on the trend line, right? And so that 50 MA, when it came down, was divergent. It's lower here than it was here the last time it touched. That's hidden divergence. That hidden divergence produced a new high. So now you're at this new high, and the bands open up. So we don't take that shark fin that's high, but what we do take is the divergence, where we're lower here and we're higher here, and then it sells off back down to the 50 MA because it's regular divergence. So it's going to reverse, and all it does is it comes down and retest old resistance. Right? So we can catch hidden divergence, and then we can catch that goes with the trend, and then we can catch regular divergence that goes against the trend. All right. And so we like this because when you're managing divergence, it sets up your rules that we don't want to take the trade unless we have a shark fin, that's one, and or hidden divergence, that's two, at the 50 MA, and sometimes at the 200 MA. Shark fins, we like that at any MA. All right, so that has to be present. That should be a rule of yours. Is there a shark fin present? Is there divergence present? If not, keep pushing on. And it can be on a lot of different time frames, but you have to have divergence or shark fin present on one of those time frames. Right? So don't spend time looking at something that doesn't have that. And we'll look at the chart tonight and see if we can spot that. But in combination with that, we don't want that just alone. We should be able to find other confluence. So usually you're going to find two or more of the following confluence. And so you're going to find a trend line. We say AOI, that's area of importance. That means great things happened in the past when price touched that trend line. So you're going to find the trend line or a trend line retest where it breaks through the trend line and comes retested. You're going to find divergence. You're going to find a key fib level, major area of support or resistance, a touch of a moving average, Bollinger Band touch. And the way we treat this is, okay, I'm going through, I found a shark fin. And then I found that shark fin on a trend line. And then I found MA also acting as support. That's all I need. Or I found hidden divergence, and I found that at the 50 MA. And I found that on a trend line. That's all I need. I could take the trade. If you get disciplined as keeping those rules, your win rate will remain consistent. If you break the rules, then you'll find yourself losing a lot. Like if you're trading in consolidated markets, you don't know if you're going up or down. You're spending time on lower time frames. You're finding it on a 5-minute chart, and the 4 hours saying that you're in a downtrend, but you can't see it because you're in the weeds. All right. So that is important to have that confluence. When you're setting up your trading plan and you're going through, make sure that you have your rules set up. Is there a shark fin present? Is there hidden divergence present? Do I have two other confluences at this area that says that this is the place to take the trade? All right. Now, how to manage this. So, two ways to manage this. I'm going to start first with hidden divergence because we're going with the trend. So if you're going with the trend, there should be momentum. You should have momentum going with the trend. All right. And so with this, we've been dropping these boxes as you've been analyzing. And a lot of you said, well, I don't know what these boxes are doing, but I'm doing it. And so really, this is our strategy. These boxes are really strategy. And so what we're looking at is when we're entering into trades, we want to do capital preservation. We want to limit our losses and maximize our gains. And so hidden divergence and shark fins are the best way to do it, because when you reach a level and you see the hidden divergence and or a shark fin there, price is going to bounce in the opposite direction. When that price bounces, it gives you opportunity to move your stop loss right away into profit. So that if price comes back down, it takes you out at break even or slightly in profit. Right? So price, say you enter in right here, and because of the shark fin and divergence, price comes down to your entry, you enter, and then it immediately goes in your direction. As soon as it goes in your direction, you can take your stop loss and move it to break even or move it to slightly in profit. Because if price reverses and comes back down and hits your stop loss and push lower and creates divergence, it gives you a better entry. It takes you out of the first entry and gives you a better entry. Right? And so that's the way that we manage it, is that usually when you have hidden divergence and you have a shark fin present, price is going to react at that level. When it reacts, we move our stop loss to break even, and we usually wait. We usually wait for, say, if I'm expecting it to turn bullish, price will come down to my entry, and then it'll start moving in my entry. And soon as it moves at least 30 pips in profit, then I take the stop loss and move it to break even. Right? So the reverse is true. If price is coming up to the entry and then it rejects and starts to go in my direction, as soon as it moves 30 pips, I take my stop loss or my risk or my exposure and I move it to break even. So now it's a risk-free trade, or I move it to into profit. All right. And then as price goes, then I continue to move my stop loss to follow it based on structure. All right, so let's look at this on our trade. Our trade is currently going. I'm on the day chart right now. Let's go down to a lower time frame here. So we entered into the trade. You see this arrow? This is where we entered into the trade. It went into drawdown first, came to the trend line, and then it pushed up, right? So this wasn't really a good entry. But what we can see here, let's say that this is the low. This candle body close here is the low. And then let's say this is a shark fin, and then price pushes lower. That would be shark fin divergence, right? If the TDI was higher. So let's say we entered in here. As soon as this candle pushes up, you can take your stop loss and move it up into profit or slightly in profit. In this scenario, price never comes back down to the entry. It never comes back down there. So you would have still been in the trade, and the trade would have been risk-free. Right? We entered in here. So we entered in right here. Price did come back. But when price pushed past our entry, we can take our stop loss and move it to break even. So now if it comes back, let's move it right here. Let's move it slightly in profit. So now if price comes back, I would make, I'm trying to hover over this, $81. right? And so now it's a risk-free trade. There is no risk of me losing. And we like that because we set high targets. And most of the time, our targets aren't hit. Price pushes up, and then it comes and reverses back on us and takes us out at break even or slightly in profit. Right? We would rather do that than come down and we lose, $2,400. We'd rather be taken out at break even or slightly in profit. And if we get taken out, let's say 10 trades get taken out at break even or slightly in profit, we didn't lose anything. And then let's say the 11th trade hits take profit. Then we gained $5,600. And our win rate is way low. We won 1 out of 11 trades. Our win rate is way low, but our risk management still has us positive. So we lost a bunch of trades, but we're still up in our account.